Good morning and welcome to Lextran's Finance Committee meeting for September. My name is Fred Combs. To lead the meeting this morning is our Finance Committee Chair, Mr. George Ward.
Thank you, Fred. Call the meeting to order. We have a quorum. So the first order of business is approval of the April 11th minutes.
A motion to approve the minutes?
Yes, I will second it. All in favor?
Aye.
Aye, okay. The big part of today's meeting is to go through the fiscal year 25 audited financial statements, and we have Brad Shelley from Crow, who is our auditor, who will lead us in that discussion.
Do I need this one?
Yes.
All right, well, good morning. Good to see you all again. And thanks for giving me a few minutes to present the results of the audit this morning. As mentioned, my name is Brad Shelley. I'm an audit partner. I'm our firm's national transportation leader, so I focus on public transit and airports, working with them around the country. So actually just earlier this week out in California, meeting with Orange County, California transportation. So all over the country, working with public transit agencies. So happy to present the results of the audit and answer any questions you have. So we'll start with the financial statements because that's really the bulk of the report here. Again, fiscal year 2025, so through June 30, 2025. The first couple pages here are our independent auditor's report, and this is really the couple pages that we're providing. The rest of the financial statements are your financial statements and responsibility and management. Our responsibility is to perform an audit and testing procedures over those financial statements and then provide an opinion on them. So you'll see our opinions are listed here. We are providing unmodified opinions, which means highest level of assurance that we can provide and essentially a clean audit opinion. There's some additional paragraphs in here around required supplementary information like the MD&A and some of the pension schedules. None of that has changed. And then other reporting around government auditing standards. Obviously, as a government agency receiving federal funds, you are required to follow government auditing standards as well. So I'll spend most of the time probably here in the MD&A because this kind of gives you a comparison of current year and prior year and a little bit of information in here. And then I'll flip through the rest of the financial statements, but just a few things to point out here. Again, this MD&A is, we don't actually provide an opinion on this because there are some explanations of variances and things like that. Miles sometimes are presented in there. Things that may not be audited information, but nonetheless we do look at this information and make sure it matches with the audit report. So at a very high level, you'll see the financial position summary here for your proprietary fund, which is, proprietary fund is the agency. You do have fiduciary activity, but really the proprietary fund is the primary activity we're looking at. Very condensed information as you look at your assets. And deferred outflows of resources increased about 6.7 million up to 93.3 million this year. Really, as you can see there, it's a combination of a few different factors. In the current assets category, most of that is related to your federal grants receivable and increases there. Some of that is just due to timing of execution of the grants. As we'll see later, your federal grant revenue increased pretty substantially this year because of that. So just a matter of when the grant was executed. We also had a paratransit grant, federal grant as well. So those caused some increases, also caused some increase in the grant receivable at the end of the year. The next two categories, the net capital assets, that's really just a factor related to the amount of capital dollars you spent during the year, whether it was related to purchasing new buses, whether it was the Avail technology, and we do have a little bit more detail on this in a couple of pages, but there's a variety of capital assets that you procured during the year. those capital costs outweighed the amount of depreciation you had during the year, and so you end up with an increase of about 2.6 million. And then the net pension asset, the fund asset that you don't really have any control over. Fortunately, you're a net asset standpoint, so you're technically overfunded as of the end of the year. Not a bad position to be in. Obviously, better to be break even or overfunded versus being underfunded. But that some of those changes in the actuarial information, the estimates, caused that to increase 1.4 million.
What are you seeing at other transit agencies on pensions?
Really what we're seeing is most are trending in this direction. A lot of it is due to investments, right? So the markets have been pretty good for a pretty continued steady amount of time. So we're seeing those assets that are in those funds continue to increase. So the ones that are underfunded are shifting to be a little bit less underfunded. The ones that were, break even or an asset are continuing to trend further that way. For the ones that are underfunded, we're seeing policies to try to move in the direction of getting that funded. I mean, it's all over the board though. So there are some that are significantly underfunded, especially if they're part of a county or a statewide plan. Those are typically more underfunded. The ones that are more the single employer plan, those they have more control over, so they can contribute a little bit more. So I think you're in a good spot. You'd want to continue to look at this. At some point, you could potentially cut back on some of the contributions you're making if you continue to grow and the asset continues to grow. It is a long-term obligation, so there's no need to be, significantly overfunded. But right now, fine. Looking at the other half of the financial position, your liabilities and net position, very limited liabilities. You don't really have much going on there, so slight increase there of 800,000, but a lot of that is just, again, timing and kind of plays into the federal grant receivable and the accounts payable that you have at the end of the year. Deferred inflows of resources is related to your pension, so again, that's related to some of the changes that you're seeing in the plan. Nothing related to be alarmed about there. And then your net pension, or your net position, is a combination of looking at your assets minus your liabilities and deferred inflows, and so you end up with an increase this year of about 4.5 million. Split pretty evenly between the net investment and capital assets and unrestricted. And again, the net investment and capital assets is just directly tied to you spending more capital dollars this year.
Would you define deferred inflows of resources?
Yeah, so deferred inflows of resources really are transactions that are going to be realized in future years. These are, again, for you, it's all related to your pension activities. So it's pension, some of it is the actuarial estimates that go into there, and those changes, rather than recognize them all in one year and really create a situation where that asset and that net pension or asset liability, net pension asset or liability increases or decreases even more dramatically based on those. This kind of smooths that out over time, so it's recognizing it over generally a 5-year period.
I think we had the same question last year.
Probably,
Right.
and it's more details in the footnote, but
Yeah.
that's what that is.
Okay.
Mentioned the capital assets already, so here's a little bit more detail on that. You'll see for this past fiscal year, June 30, 2025, kind of broken down into 4 categories there of the significant changes or investments that you've made. Bus and charger purchases, paratransit vehicles, obviously some building improvements to the transit center, and then Avail technology upgrades. You'll see those all included in your capital asset roll forward at the bottom of the page. At the bottom of this page is a very condensed version of your changes in net position or your income statement. So as you look at operating revenues, about 4.3 million, not much variation there. Again, pretty much in line with what you'd expect based off of ridership and things of that nature. Operating expenses actually increased a little bit, combination of inflation, rising costs, but also some additional costs built in there.
We had some labor, right?
The cost of labor is certainly the biggest factor in there. So that gets you to a loss before depreciation and non-operating of 30.2 million. You had depreciation expense, which is a non-cash expense of 4.1. And then towards the bottom of this, you'll see non-operating revenue and expense, and that's really where your grant dollars comes in, your state funding comes in, the tax revenues, that's all flowing through there, which gets you to your overall loss of 3.4 million before your capital contributions of 7.8. So your change in net position is $4.5 million positive this year. But again, a lot of that is fluctuating based on the capital contributions. And this year you had an increase in your capital contributions of $4 million. If you think about the accounting for this, the capital contributions are going to directly fund what goes on your financials as an asset initially. So there's no expense to that. And so the expense is really in that depreciation that's recognized over time. So I point that out just to show, your change this year was about a $5.5 million change in your overall change in net position. A big chunk of that was related to your capital activities and the capital contributions that you received. If you look at the line above that, that's a little bit more reflective of what I'll call operations, where you had a positive change this year of about 1.4 million. So trending in the right direction. This gives you a little bit more detail of the revenue comparatively. And again, not really a lot of changes in here. As you look at the breakdown here, property taxes obviously is the bulk of your revenue. That makes up about 59% of your revenue for this year. About 11% is federal assistance. And again, as I mentioned, the bulk of that change is really a combination of new grant funds this year and the timing of your grants being executed. If you recall, a few years ago, the GASB clarified that you can't recognize any revenue on federal grants until you've actually executed the agreement. So even though you may have pre-award authority and you can start spending on those, you can't actually recognize revenue. And so that's really the biggest piece of that change this year is one of the grants from last year wasn't executed until this fiscal year. And so the bulk of that revenue was recognized this year. Passenger fares makes up about 9% of your total revenue. And then you have a little bit of other revenue, state assistance, advertising, etc. On the expense side,
Property tax was almost 6% increase. We feel it at home. Which is about 60. That's a big number. Okay.
On the expense side of things, you'll see about 62% of your expenses are operations, about 13% is maintenance, and another 13% is general and administrative, and then about 11% is depreciation and amortization, which again is a non-cash expenditure. Not really a lot of changes in here year over year. The operations is the biggest piece, and again, we talk about from a compensation standpoint, that's where you're seeing a lot of that increase in costs. Most of the other categories were 2 to 5% increase.
So in your opinion, our capital investments are keeping up with depreciation for the
Yes.
most part, right? Especially in more recent years.
Yeah, and I think when you're seeing the capital expenditures outgrowing the depreciation, that tends to mean you're in good position to keep up with that. Where you'd be concerned is if your depreciation was much higher and you didn't have much capital dollars, that means it's going to catch up with you at some point, because you're going to have those either bus costs, infrastructure costs, whatever it may be, to maintain those down the road. So it's really important to be maintaining those assets as you go along. Question? The last one here is just cash flow activities, and really not a lot to take from this. You can see it's broken down into the 4 categories of operating, non-capital financing activities, which is, again, kind of the property taxes and the grants. So I kind of look at those two together, the operating and the non-capital financing together, because those relate. Then you have your capital and related financing. Again, that's going to be around your capital dollars and your investing activities. Was about a $200,000 increase. So overall cash change was pretty minimal this year, about $160,000 cash change this year. So from there, you get into the basic financial statements, and again, I've kind of covered most of the highlights in here. So I'll skip through these unless you had specific questions. This again just breaks it down into more detail and into the categories required by GASB's. But nothing too particular here to point out, other than you can see the federal and local grants receivable is $6.7 million. As I mentioned, that's the biggest change in the current assets. No other significant changes here. Your statement of revenues, expenses, and changes in that position, again, just a little bit more detail, but again, we talked through this in the MD&A section. And your cash flow statement. Do have the fiduciary statements here as well. So as I mentioned, the first are called proprietary statements. Those are really the transit agency. The fiduciary statements are specific to the pension, and so these are really your pension financial statements. Assets of about $23.8 million. You have no liabilities. It just breaks down the types of assets. You can see the additions to the plan during the year. So those are your contributions, either employer or the employees. And then your investment earnings. And as I mentioned, that's where you see the big change. So investment income was a positive $2.9 million this year, and that's what's generating that increase in your net pension asset on the transit agency financial statements, because that's outgrowing or outdriving those benefit payments of $936,000. Any questions on any of that before I go through a few footnotes?
Jen, you need anything? Good?
I'm good.
Okay. I know this is riveting stuff on a Friday morning, so.
I was hoping
but
Harding would be here because he would have been able to dig into these a little more, but anyway.
these are all positive, though. It's much better than maybe some other conversations that I'm having with other agencies. So. And the notes, the financial statements, I'll just point out a few things and kind of quickly go through these. Note 1 is just describing the significant accounting policies. So nothing really changed too much here. You will see a little slight wording change in the compensated absences. There was a new accounting standard, GASB 101, titled compensated absences, that required you to look at that and take a look at the types of leave that you have, potentially accrue things a little bit differently. I skip ahead a little bit, you'll see here at the top of the page, there was about a $319,000 impact related to this. It increased your compensated absence liability. Doesn't really change anything. It doesn't require you to pay anything additional out. All it does is require you to look at your compensated absences, the types of leave, and determine what types are more likely than not to be paid out or used in the next year or so. So previously you had been accruing any types of leave that you were required to pay out. Now it requires you for things like sick leave or other types of leave that maybe you don't pay out immediately, or if there are, if it's tiered to where you pay out leave once you hit a certain threshold, right, of 5 years, 10 years, however many years of, you have to look at those and say, is it more likely than not that we're going to pay this out? So if the tier is at 10 years, you're required to, they become vested at that point, and they're at 9 years, it's more likely than not that's probably going to be paid out if they're a year away at this point. So you kind of have to look with a little bit more nuance and see if that's going to be either, again, utilized or paid. The other aspect, the biggest aspect, was looking at and seeing how much was actually used of leave during the year and making sure that there was an estimate for that amount to be accrued. So it doesn't really change a lot, and I wouldn't anticipate this liability to change much year over year now that it's been increased. I think it's more of just a matter of implementing this one time. You'll adjust it annually, and I don't think you'll see near as much of an impact. And even the $319,000 is not a significant impact, and so we'll see later in the audit communications letter, the decision was made to just waive that. Under the GASB, it says you're supposed to apply that retrospectively, meaning apply it to the beginning of the year, and then also apply it to the end of the year, which means doing 2 different calculations. It's a pretty immaterial amount, so adjustment was just posted at the end of the year, and we're fine with that. So that's typically what we've been seeing most other agencies do, because in most cases it ends up being an immaterial adjustment. While we're on this, I'll point out the other new GASB this year, certain risk disclosures. So this is just looking at potentially any significant concentrations or constraints that you may have. This is one where some transit agencies are going to have additional footnote disclosures because of this, as they are looking at potential fiscal cliff and what constraints they may have because of that, what constraints they may have because of federal funding, lack of funding, concentrations of funding. As we evaluated your position, didn't feel like any additional disclosures were needed for that, and I think Nikki agreed with that as well. So you won't see any additional disclosures for that. Technically implemented the GASB, but no changes from this.
But other places you're saying you're overly reliant on federal funds and you're at risk.
It could be that they're heavily reliant on federal funds. It could be that they have other property tax, sales tax, other types of funding where they're either reliant on those or they need additional funding. I think where we're going to see probably the most disclosures are the ones that are looking at potentially, again, a fiscal cliff in the very near future, and what type of, are they going to have constraints on their operations because of that, or do they have fiscal concentrations that are causing that, or both? So that's kind of what we're seeing with some transit agencies. I wouldn't say it's all. It kind of depends on your situation, age. Some of it goes back to infrastructure needs, honestly, and capital needs, and looking at those. Some of it's dependent on size. As you're probably aware, funding mechanisms are varying across the country. So for you all to have you got to pay a lot of property taxes. It's beneficial to Lextran to have those property taxes as a revenue source. Other places maybe don't have as much of those types of either property sales or other types of funds. As I skip through here, really not a lot of other changes in the footnote disclosures. These are all pretty consistent. There were no changes as far as any new accounting standards related to any of these, and really nothing significant that changed during the year. Note 7 is the one that goes through in great detail of your retirement plan, and you can see some of the activities there and the fluctuations. I think one of the things that's a little bit interesting here is you see at the bottom of the page the sensitivity of the net pension asset. This is one where you can see how much of a fluctuation there is just based on a 1% discount rate change. Now in your case, doesn't really matter if you went 1% either way, you'd still be in an asset position. But nonetheless, it's approximately $2 million change one way or the other, just based off of a 1% discount rate change. So just highlights the fluctuations you can see in that asset. So move to the supplementary information. This is again more pension information. You have reached the 10-year threshold now, so this will stop and continue to just be a 10-year schedule. And also the schedule of contributions. So you can see you continue to make contributions in excess of the required amount, which has helped put you into the net pension asset position. And the last schedule related to pension as well. As we move into the last part of the financial statements, this is part of the single audit, which is related to your federal grants. And I would say at this point, it is very likely that we are going to have to issue 2 separate reports this year. One that we'll call a short form, which would be the first 31 pages here. And then we will later on issue a separate either single audit report or a long form report, which would include this entire package. And the reason being is that the OMB has not issued the 2025 compliance supplement yet. So typically that happens around July, maybe August at the latest. This year they still haven't issued a final version. So they've issued a draft version that we've used for testing purposes to be able to test these grants, but they haven't issued the final. And so based on that, the AICPA has strongly recommended that firms don't issue any single audit reports, just because we don't know. Like, will they change anything in the final version? Probably not, but it's hard to say we're following the compliance supplement when they haven't actually issued it yet. So nothing to be alarmed by from that, and everyone's going to be doing the same thing. Anyone who's trying to file right now is going to have to finalize their short form on its own, and then once the compliance supplement is finalized, we'll be able to issue that as well and submit to the Federal Audit Clearinghouse. But just from an efficiency standpoint, thought it made sense to go ahead and go through the results of the audit, and of course, if anything substantial changes in the final version, we'll let you know.
Any reason for the delay in the compliance supplement?
No, I don't really know. I don't know if it's, speculation on if it's administration change, if it's reviewing, some of the language around grants and things that you had to comply with. I'm not exactly sure, because what we've seen in the draft hasn't really been it's not substantially different than any previous versions. The only changes are really increasing some thresholds as for major program determinations for whether you need a single audit, and then there was some changes in removing some of the high-risk programs that were COVID related. They've removed some of those and said those are no longer high risk. So no, not sure what's the hold up at this point. Since they've given a draft, it seems like it should be ready to finalize, but they've had a draft for probably a couple of months now. So this is your schedule of expenditures of federal awards, your federal grant expenditures during the year, about $12.7 million. Again, some of this is capital, some of this is operating related. The bulk of it is your federal transit cluster. All of those first 7 grants are part of the federal transit cluster, so we test those all as one grant. The other 2 grants, much smaller, those don't require any kind of compliance testing.
This is very in the weeds, but
Sure.
the ones that say like 2019, 2020, are those just money that we're still spending down from that year?
Yes, 5307 funds. We have some funds remaining for things like hardware, software, shop tools, things like that.
And that's pretty normal to see those go back for several years. As we get into the two reports, the first report is our report in accordance with the government auditing standards. This is really more specific to the financial statements themselves and to the schedule of expenditures of federal awards. So we did not identify any significant deficiencies or material weaknesses or compliance issues in that. So a clean audit report there. The second report is specific to the major federal program, which is the Federal Transit Cluster, as I mentioned. So based on our compliance testing, internal controls testing related to the Federal Transit Cluster, we did not identify any significant deficiencies or material weaknesses there either, nor did we identify any types of compliance findings or issues of non-compliance. And this really kind of summarized here in the schedule. Everything on the right-hand side is a no or none reported is what you want to see. And then from a threshold standpoint, you see that listed here. You see the one grant cluster, the Federal Transit Cluster. You do continue to be qualified as a low-risk auditee. So very clean. That covers all the financial statements. And I do have two other letters to go through quickly, but if you have any other questions on the financials, I can.
Have we ever been a high-risk auditee in our history?
Not since I've been involved for the past 4 or 5 years. I don't know beyond that. I don't know.
About 20, probably 20, it's probably been 20 years ago.
And there's different things that can result in being a high-risk auditee. Some are less risky in my point of view than others. Things like if you don't file your data collection form within 30 days of the audit being finalized, that automatically moves you to a high-risk auditee. Other times it's more significant though, like if you have material weaknesses in grant compliance, that can push you to that. So I will say in your instance, honestly, you want to be in the low risk, obviously. It wouldn't make any difference because you typically only have the one cluster of grants that we had to test. And being a high-risk auditee just shifts the requirement of we have to test at least 20% of your expenditures versus 40%. And your federal transit cluster is usually 90% or plus 90%. So we would end up testing the same grants every year.
Nikki, what was the cause of high risk? Was it before the
Some findings.
property tax? Oh, findings?
Yes, it was.
Okay.
It was probably early 2000s. Just some recording and a few.
So a couple letters here. This first one's just a one-page letter, what we refer to as the management letter. This is where we disclose, again, any significant deficiencies or material weaknesses. We had none. And then the second letter is a little bit longer, about 4 or 5 pages. What we refer to as the audit communication letter, and this just goes through a variety of information and again outlines our responsibilities, communicates that we are independent from Lextran, which is important as providing an independent auditor's report. So we do assist in the preparation of the financial statements, the CFA, et cetera, but that is allowable based on the standards. So as long as management reviews that, and Nikki has already reviewed the financial statements, so as long as you're reviewing those after we prepare them, and because we're using your trial balance, your information to prepare them, that's an allowable activity. Some other information in here, if we had any concerns about selective recording of journal entries, things of that nature, we'd make you aware of those. We did not identify anything of that nature. I already mentioned GASB 101 and the impact of implementing that this year, so not much to discuss there. These accounting estimates are listed here. There's estimates that are always involved in various types of accounting for transactions. These are all consistent with the prior year, and really what we're looking for when we're evaluating these is, do you have supporting documentation for these estimates? Are you providing, or are you applying consistent methodology to them? Even if the estimate might change slightly, but are you applying a consistent methodology to those? And so we have no concerns there. The second to last page just goes through a few other items. And then at the bottom of the page, you'll see any corrected or uncorrected misstatements. And so we did have one relatively minor adjustment here, just to post accrued wages payable to adjust that. That was really just an adjustment of that accrual at the end of the year. About a $491,000 increase, or sorry, decrease to your expenses because of that. And then, as I mentioned, the uncorrected misstatement is the GASB 101 implementation, where you chose to just implement that at the end of the year versus the beginning of the year. So, again, pretty normal for what we're seeing in the industry, immaterial adjustments, so no need to go through and calculate it twice. Last couple pages just go through a few bits of other information. Again, if we had any significant difficulties, disagreements with management, if there were other consultations, anything along those lines, we make you aware of those, but there were none. So overall, very clean audit process. We were able to work through things efficiently, and just appreciate Nikki and the rest of her team being prepared. As always, always prepared, always has all the exchange requests for us ready for us, so we can jump in and start doing the testing. We can start preparing the financial statements. Even the financial statement review, I provided her the draft and she turned it around the same day. So very, very efficient, helps us get through the process, and much appreciated. So that's everything I had, but again, happy to answer any other questions you might have.
I don't have any other questions. Jamie, anything?
I don't. Next year, and I apologize, I've lost my voice a little bit, after we finish the renovations of our downtown transit center, will we see that as an increase in assets?
So those were already, the amount that you've already spent is already reflected in your capital assets. So I don't think you'll probably see as much. You don't have you're towards the tail end of that, so there will be some additional increase in assets
It
for.
was like 1.8 something, wasn't it?
Yeah.
Yeah.
It's about a little over half.
So
It
there'll
was
be.
paid in this last fiscal
Yeah.
year.
So you'll see some in this next year, but the part that's already been expended is already in your assets. Anything else?
What else, if anything, are you hearing with some of the other transit agencies that may be helpful to us? Just trends that they're seeing, or anything that they're doing creatively that maybe we could take a look at?
The big discussions have been mostly around grants and the new administration and how that's going to impact potential different agencies. Some have different policies, that may not align with administration's policies on DEI, on the immigration policies, things like that. So there's a lot of discussion around that, and whether they'll be enforced, whether agencies will lose grant funding because of that, whether there'll be any shifts of grant funding. So I think it was yesterday or a couple days ago, I think they said that they're pulling funding from the California high-speed rail project. I can't remember how many billions of dollars from that is supposed to be reallocated to other capital projects. So I'm not sure yet what the impact's going to be, if they're going to open that up to competitive grants. I don't know yet, but things like that are kind of what we're seeing as a discussion point. Fiscal cliff is still a discussion point for a lot of transit agencies, and again, that varies pretty significantly from place to place. Some are in a really good financial position, such as you all. You don't have really any debt. Others are pretty debt laden already and looking for ways to try to find more funds. So that continues to be a discussion point. Some of the changes with the energy, so the Inflation Reduction Act was just I'll call repealed. It's going to be repealed over time, so some of that is going away as early as the end of this month in just a few days. Some of that's being phased out over time, so again, how that'll impact either in potentially tax credits being available or even shifts in, how agencies choose to operate. Do they go away from electric? Because there is some issues still with some electric vehicles, especially depending on what geography and climate you're at. So do they shift to CNG, to hydrogen? I'm not seeing really too many going back to diesel, but will that change plans? I don't know, but there's some discussions around that. So, those are the things that I have been having discussions with other finance folks from transit agencies. The other thing I'll mention, just from the boring side of things, from the accounting standards, there's a couple of new standards for next year, neither of which I expect to really have much impact. The one is around financial statements, and there's a little bit, you might see some changes mostly in the MD&A section for some new required information, but I don't expect to see, changes on your balance sheet income statement from a result from that. The other one, GASB 104, is around certain types of capital assets and splitting out intangible assets from tangible, splitting out a little bit more detail there. So again, maybe some footnote disclosure impact from that, but nothing really substantial. So right now, pretty quiet on the accounting standard front, which is, I'm sure, a relief to Nikki, and it's a relief from us, frankly, as auditors as well. That's all I got.
I have
What-
a, oh, go ahead.
Yeah, just to follow up on the standards.
Mm-hmm.
What generates discussion, to change some of this stuff? I mean, I understand the stuff that you do with leases, and I know
Yeah.
it impacted what I do a lot at UK,
Mm-hmm.
and I know why it's important to do it. But like some of these other things, you just kind of wonder.
Yeah, I'll say that's part of GASB's role, is to continually review and assess the financial reporting and whether there is information that could be provided, disclosed differently, to help better inform the users of the financial statements. I think at times you have these slower periods of times and they're probably digging a little bit closer, is my personal opinion, and so you kind of start digging into some things. At the same time, now I will say they do go through a post-implementation review process, so they're in the process of looking at, I think they're starting with GASB 87 right now. They've already done some post-implementation review of GASB 67 and 8 related to pension and OPEB. So they do, once they implement these, they do then go back and try to understand, is the impact what we thought it was going to be, hoped it was going to be. Now I've yet to see anything really be repealed or changed from those. GASB 87 and 96 related to the subscriptions will be interesting to see if they make any changes there, because what we see with at least some of the entities that do have a lot of leases is they end up pulling that lease activity, that subscription activity, out of the monthly, quarterly financial statements, because it doesn't really mesh well with their operating. We're seeing more and more of these things similar, like the pension. From an operating standpoint, it's hard, you can't really budget for that, right? And you don't budget for lease activity necessarily the same way that GASB 87 is wanting to account for it. So I'll be curious to see over the next several years what happens. Do they pull back any of this? Because most of the stuff that has been added lately are things that places are calling gap only adjustments, and they're not necessarily utilizing that information on a month-to-month, quarterly basis, which is really the information a board, a finance committee is using. You're not using the GAAP audited financial statements to make decisions typically. So we'll see where it goes. Like I said, I have some opinions on it, but I don't get to make the standards either. So.
Yeah. So who makes, how's the board appointed? Is it?
Well, there's different, so there are employees of the board, and then there are appointees to different committees who provide feedback to the board. So, for example, there's a variety of different expert panels, committees. Those are typically comprised of a combination of, it's mostly public accountant, CPA firms like ours that have representatives on there providing feedback. They do try to obtain feedback from other industry groups as well. So, I work with airports, for example, also. Those are transit agencies, and airports are the two I work the most with. They're meeting with an airport industry group, GASB is, to discuss and understand, what is the impact from your all standpoint. I don't know on how they appoint or how the actual GASB employees are determined, but from as far as appointments to these different committees, it's typically volunteer roles, and they're voting based on those who wants to volunteer for it.
Just curious.
Yeah.
Jamie?
Well, mine was very in the weeds. The investments, I can't remember the slide, my computer died.
Sure.
It was like broken up into 2 different investment bonds and stocks. Is that all of our pension investments? And then so the pension board, I've never sat and watched our pension board. They look at those every time they meet and how we're investing those.
Yes, quarterly.
Yeah, I think if you go all
And
the
you
way
have an
down.
investment policy.
Yes, we have an investment
It's
policy
in
and we
here.
use
Yeah, it's
Mariner, and they go over the report in a lot of detail every quarter.
Yeah, and there is, I think,
Want something
I was going to say,
in the footnote there, it lists
I was thinking that when I left the other day.
the very high level policy there as far as your target allocations of domestic fixed income of approximately 35%, equity 60%, cash 5%. Those are high level, so it varies a little bit from there.
And I think in a slide before or after, did it talk about the growth of those investments?
Yeah.
Yeah. Just lost.
Yeah, you
Well,
can see kind
The
of,
one that had the year to year, is that what you meant?
Yes, and
yeah,
Just at the end of it.
yeah, so here you can see at a high level for those investments in the pension fund. Your appreciation or your unrealized activity is the $2.5 million increase, and then you had some interest and dividend income.
And George is referring to page 31.
and then at what point do you advise a board, you're so overfunded, you need to start looking at it cautiously? Because right now I heard you say like, don't do anything different, overfunded is good, but is there ever a point where you're so overfunded that the board needs to do anything differently or no?
It's like we got like a 1.27 coverage right now.
Yeah, yeah. I don't know if there's any guidance. I've never provided any guidance, never heard any guidance. It's more of just kind of what is the board comfortable with.
Mm-hmm.
I tend to think that you would want to be more around break even, is just my, again, personal view on it, because these are costs that you're going to have to pay out over years and years and years. Like some of these benefits may not be paid out until 30 years from now. So the liability that, if I can find it. So your liability there is, your total pension liability is that first column is 18.7 million.
Okay.
That's what is estimated liability over the life of this entire plan based off of all the employees. You're not going to have, as you can see, the benefit payments, you paid $936,000 out this year. So that 18 million is not coming due anytime soon. So I would say you're getting close, and as you look at your contribution schedule, which was in the, right here, do you need to be contributing more than the ADC every year? No, probably not at this point. You could probably just contribute that amount. Not a huge amount. I mean, you're only contributing another 150 to 200,000 per year, but that over time contributes, and that's why that's partially why you're seeing this net pension asset go up. Now, I will say on the flip side, the investment activity can turn on a dime. So as you look here, 2022, the net investment income was a negative $2.5 million. So if you have a year like that, that's going to wipe away quite a bit of your net pension asset pretty quickly. So it's kind of a balancing act on that.
And the pension contributions are driven by the union contract. And we have the pension committee's made up of 3 union members.
Yeah.
So, and 2 administrative and 1 board member. And we review that every year. We get the actuarial report every May, and we review that in that committee because they're always asking, you know, when can we raise benefits? When can we do this? So we did last October, we raised it from a $50 a month benefit to $60 a month. So that's the kind of stuff when we start looking and we say, oh, well, we have, you know, have a little bit of surplus, and the actuary kind of guides us through that. And they'll ask questions, you know, they've asked questions, you know, like, can we do, you know, things from like a 30-year and out, or, you know, can we raise the benefit? Can we reduce the contributions? Things like that. So we do look at that very, very thoroughly in that committee.
So that's the alternative. Instead of reducing the total pension amount, increasing the benefit that's paid out.
Yes.
Thank you.
$60 a month doesn't get much.
$60 times the number of years you've been here.
Okay,
So
that helps.
10 years, $600 a month
Still not switch it too far.
For life?
for life.
Okay.
Anything else?
I think,
I think we're good. Yes, thank you.
Okay.
thank you, Brian.
Thanks, Brad.
Thank you, Brad.
Do we have any old business or new business to discuss? Nothing. We can, what,
Does he
Jamie?
come back and formally give the single audit presentation, or do we do?
For
Yes.
October,
Yeah.
yes.
Okay.
We'll do a real high level.
But, and that's just given the unknowns about the O and B
It'll
compliance?
probably be just a very high level of this, since
Okay.
we already went through the single audit. Now, if something, like I said, if something changes significantly, then I can come back and provide more information on that, but
Sounds like it's not gonna change.
I don't
significantly.
anticipate it'll change much.
With that, we can stand adjourned. So thank you.
Thank you.
Thank you.
Thank you. Nikki, thank you.
Thank you.